Okay, hi everyone. Welcome to Financial Management One-on-One. In this video, we're going to break down the complex financial concepts into something fun, simple, and also actionable. Today, we're going to diving more into financial management, which is the backbone of every successful business and also smart investment. Okay, let's start. In talking about the financial management, I'm going to split this video into 8 chapters. First, we're going to talk about the introductions. We're going to talk about the time value of money. Next, we're going to talk about the capital budgeting. We're going to talk about the analysis of securities. We also talk about the capital structure. The next one is we're going to talk about the corporate restructuring. We're going to talk then about the fraud risk management. And the last one, we're going to talk about ESG. Okay, now we're going to talk about the financial management in detail. The first one is, what is the financial management? Financial management is an optimal orchestration of an internal and external financial resources towards significant and sustainable value creation. There's 4 main goals. The first is basic. Second is an operational. Third is the social. The last goal is about the research. So, what to manage in financial management? The first is the capital structure. The second is working capital management. The third is about asset structure. Fourth is revenue management. 5 is cost management. 6 is cash flow management. 7 is growth management. 8 is risk management. One of the important concepts is, what is the goal of the firm? We talk firm all the time, but who knows the goal of the firm? So in that sense, the goal of the firm is to generate high return with manageable risk. And the key is to generate significant value creation, but also sustainable. So now we move into time value of money, or we short it with TVM. Time value of money is a fundamental concept that suggests that sum of money has different values at different point of time. It means that $1 today is worth more than $1 in the future. And from that concept, there's 2 main things. The first is compounding, the second is discounting. The result value of TFM, there's 2 things, which is the future value and the present value. So in the slide, you will see 2 formula that you can use, but to calculate that formula, you need interest rate, expected interest rate, and also the numbers of the period. And using these 2 information and put the money that you have or the money that you expect, then you will find the future value and present value. Okay, now we're going to talk about capital budgeting. So capital budgeting is actually a process used by business to evaluate potential major project or investment. So what is the purpose of capital budgeting? There's 3 main purposes. First is estimate expected future cash flow. Second, evaluate the project based on capital budgeting evaluation criteria. 3 is decided a project. In the end, actually you need to decide the project whether it's good or bad. When we talk about capital budget, there is a method how you can actually quantify whether a project good or bad. The first method is payback period. Payback period actually calculate the time it takes for a project to recover its initial investment. The second is net present value or NPV. Third will be the profitability index. The profitability index is measured the ratio of the present value of the future cash inflows to the initial investment. The final concept we're going to talk is ERR, which is internal rate of return. Determine the discount rate at which the net present value of a project becomes 0. So, within the investment strategy, there's 2 types, which is the passive investing, it's only following the market. The second is active investing. Active investing is actually divided into 3. Fundamental analysis, technical analysis, and also market and investor sentiment. On the fundamental analysis, one of the concepts is financial ratio, which is utilizing all the financial report or statement like balance sheet, like income statement, like cash flow, and generating a ratio to find out the healthiness of your company or healthiness of your investing portfolio. Within the financial ratio, there is 5 financial ratio that commonly used by all the financial people. First is the profitability ratio. Profitability ratio basically count the overall effectiveness of the firm's management to generate sales, and also profit. The second ratio will be liquidity. Basically, liquidity is to measure whether your company is liquid or not. The third will be the activity ratio. The activity ratio is to measure how effective the firm using its resources to generate the sales. You also have the fourth ratio, which is leverage, which is to make sure the company's debt to the other financial measure and shows company capacity to meet its short and long-term obligation. And the last one will be the market ratio or valuation ratio, which is to assess company valuation and market perception. Yes, you have all the tool from ratio analysis, but what is the limitation? So we find out few limitation of this analysis. First is the seasonality. Second, window dressing. Third will be different in accounting practice. Fourth is industry average are not the goal. And the last is they got data from balance sheet or other financial statement. Other than that, there is also two other important concepts, which is CAPM is capital asset pricing model. The last will be the WACC, which is the minimum return that the company need to earn on its investment to satisfy its investor, whether it's both debt or equity holders. Next, we're going to talk about the capital structure. What is the theory of capital structure? Benefit of debt financing is that interest is tax deductible, where payment to equity are not. However, firm must trade off this benefit against the increased financial risk by having a high debt ratio. What is the capital structure in real world? A firm, any firm, attempt to balance the cost and benefit of debt to reach the optimal mix that maximize the value of the firm. Next will be the corporate restructuring. Corporate restructuring is about making significant changes to a company operations, finance, structure to improve its performance and competitiveness. In surviving and transforming mode, when the company is in problems, in simple, there is a 6 step to do. First, find out the bleed and stop the bleeding. Second, financial restructuring. Third is temporary pivoting the business. Fourth, strategy realignment. 5 is redefining core business. 6 is to define a new ways of doing the business. Okay, now we're going to talk about fraud risk management. What is the type of financial fraud and abuse? What are the things that consider as fraud or abuse? First is the corruptions. It could be conflict of interest, it could be bribery, it could be illegal gratuities, and also economic extortion. Second would be the asset misappropriation. It could be how you handle cash or inventory of all other assets. The third is the fraudulent statement. It could be the financial statement or the fraud on non-financial report or statement. Now, what is the reason for fraud? There's a multiple reason, but it could be personal debt, it could be the lifestyle, it could be over speculation, it could be gambling, unfair treatment, pressure from above, alcohol or drugs, and the last will be affair. There's many things, but mostly around this 8 things. The big question is how a company can prevent a fraud. First, build employee ethics. Second, create SOPs. Third, train your employees for alertness and how to prevent. Fourth is protective security on all. And then the 5 is create a whistleblower mechanism. The last concept of financial management is the ESG. ESG is environment, social, and governance. It is a framework used to evaluate the sustainability and ethical impact on an investment in a company or a business. So it starts with investment, and if you considering the ESG on all your decision, it leads to sustainable and long-term investment. So the last is sustainable finance, which is to combine sustainability and the finance. First, on sustainability, it could be environment conservation, social responsibility, and governance. While on finance, it will be what happened in financial market, in your investment strategy, or the banking service. If these can combine, then sustainable finance can happen within the company and your business can be more sustainable for the future. So the conclusion is learning financial management empowers us to take control of our finance, make informed decisions, and build a secure financial future for you or for the company. This valuable skill benefited both individual or the company at every stage of their journey to make sure you can manage all the financial resources for significant and sustainable value creation. So that's it from me, all that I know about financial management, and hope you like it. Thanks for watching. Don't forget to like and subscribe in this video, and if you have any questions, comment below and I'll do my best to answer every of your questions. Thank you everyone. Stay smart.